Well, the one thing I saw, Rob, that I never knew about you in the Macaulay Garrett newsletter is that you visited all 50 states with your kids when they were younger.
I did. It was a great time. Very good time.
And, as the parent of two teens and like step parent of two more teens, you had to have done that before they were teenagers, right?
Yes. Back when I could say, pipe down or I'm going to come back there when that meant something.
Reach the hand back.
Just so Rich, it was interesting. I've gotten some interesting responses because I had the NBA's financials in my commentary today, and some people have looked at those and said, "Oh, these are interesting." So for listeners, it's might be worth a gander. It's good to know. It's good to know what the NBA is up to, and I think it's a great organization, as I mentioned. But everybody's just revealing all these financial details about their companies, and with these companies going public recently, it's nice to see performance and so forth. It's good. It's a good link to check out.
Good deal.
Excellent. All right, well, let's go ahead and get started. This is the Rundown with Rob and Rich. I'm Rich Swerbinski with the Mortgage Collaborative, joined, as I always am, by Rob Krisman. Rob, good to see you in the background. Making me yearn for something besides the Midwest in May.
Jealous here too.
Yeah. No, the next two big conferences I go to are in Florida in early next week, and then again in June and for the Eastern Secondary. So Florida's the place to be.
Excellent. And can you guys hear me okay?
Hey, you keep
pausing. A
pausing.
little lag, I think, Rich.
Yeah. Hey, Rich, Chris and I will just take it from here.
Okay. Give me just a minute to get my connection issues figured out, and I'll jump in. So, Rob,
Chris, what's
take
going
the pilots.
I like it. I'll reintroduce myself, Chris Bennett from Vice Capital Markets. These guys are nice enough to let me on the program one last time. I'll try and behave so I don't get kicked off early this time, like they threatened to with the other time.
But what's Vice Capital do every day? I mean, I know, but I'd like to hear it.
Really from before the market opens to the market closes, it's everything to do with that. It's all the position reporting for lots of banks and mortgage companies all over the country. A lot of times it involves, most of the time it involves trading mortgage-backed securities, trading whole loans, working with a lot of folks who do all their own trading to make sure the reporting is done right, helping with advice and counsel, really everything that has to do with, especially the capital markets part of a mortgage banking operation. So whether it's a mortgage company, a credit union, a community bank, all sorts of other kinds of folks. We work with them from coast to coast, actually. So not just in Rich and I's frigid Midwest, which we were just talking about earlier. So lots of folks.
I used to get this question a lot when I was a partner, and I'll play devil's advocate with you because I'm sure you've heard the same thing. So you have a potential client who's coming to you and saying, why don't we just, for every $1 million of locks, we'll sell $850,000 of MBS that matches the locks we're taking and call it a day. Or for every 10 million, we'll sell 8.5 million, 85%, or we'll just pick some number in the 80s because that's where we always fund. How do you talk to a potential client who says something like that?
Sure. I think it's not something you want to guess at for sure, especially if you take a look at as the numbers get bigger. 1%, 2%, 5% makes a huge difference when the market makes a big move if you're on the wrong side of it, right? Kind of if you haven't done the research, if you don't know how you can expect your pipeline to perform, as the market ticks up and down each day, as loans are moving through the pipeline, it's a very dynamic and constantly changing animal. And you've got to be able to make accurate predictions all the time about it to be able to keep those hedge ratios in line. You're right. You can't just say, well, when it's submitted, we'll call it 75%. When it's approved, we'll call it 85. When they draw the docs, we'll call it 95, because there's so much more to it. And part of it also comes down to Do you have like a renegotiation policy? How are you going to market? Is it a lot of wholesale? Is it a lot of retail? And even within the retail sector, are they traditional one-officer retail relationships with realtors, or is it a lot of call center business? Are the folks in that call center, are they locking loans right as they get somebody on the phone and say, I'll email you an application, I just locked you in? That's going to perform terribly different than a traditional realtor relationship, or even folks that it's a regular rate and term refinance, but there's a relationship in play. You're not just somebody who called them up and they're going to go ahead and say, yeah, we'll go ahead and lock your loan. So you've got to really know how it's going to perform. It makes a big difference. You take a look at $100 million pipeline and you're off by only 10%, but the market's moved a point against you. Those are real dollars that you can't just get back. You can't just turn the dial back the next day and get it back. So it makes a big, big difference. All the strategy in the world won't help you if you're not looking at the right numbers in the first place, right? I mean, you know that from your decades of experience in capital markets.
Right. Yeah. Back during the Eisenhower administration, the herd out there is spooked based on some of the footprint, some of the moves that Director Calabria has made lately. Especially the second homes and non-owner occupied loans, and lenders in Florida, for example, speaking of Florida, who do a lot of second home financing and so forth, are reasonably and with good reason concerned about the caps. And I've talked to several larger lenders who, the 7% was what was published. But because they are already so far over, one or both of the agencies have come back to them and said, we're going to limit you to a lower percentage from here, for the remainder of the year or some period. Are you hearing that out there among your clients? Are they?
We're hearing that? Yeah, we're hearing a big mix, and it was kind of Rich was talking about. He's hearing from a lot of TMC members. We're starting to hear that too about Freddie Mac coming out with an announcement, even saying everyone's going to have to be 5% for a while, because they've got. I mean, in the end, I think it comes down to FHFA has said, here's what you have to do. So Fannie and Freddie, who are they're independent, and even just the ways from a system standpoint that Fannie Mae and Freddie Mac are able to track things and handle cash commitments or securities, they're not the same. So Fannie Mae's got to handle things one way, and Freddie Mac has to handle things another way. And a lot of it can actually have to do with how their systems are set up. Because when we've seen a lot of the bigger folks, they're all over. You've got to do this. Here's what's happening. Different degrees of monitoring. Some folks will say, well, Fannie Mae, Freddie Mac, tell me what's my percentage. They'll say, we're not sure. Why don't you tell me what you think your percentage is? So we're hearing a lot of that. These aren't things that really had to be tracked a heck of a lot before, and now they do, and now it's a big deal. We're hearing from a number of smaller sellers that they haven't really been contacted yet, and it's a case of Fannie and Freddie both have to focus on this big aggregate number, and so they've got to focus on the biggest pictures of that denominator. And not that smaller folks are going to be exempt from it, but they're just some people just haven't hit the radar yet. And I wonder if maybe this is one of the cases where if Freddie Mac does come out and say, here's our announcement, here's our policy, everybody's 5% for the next 6 months, whatever that is, it's a way of making sure that at least we have kind of a level playing field for everybody, instead of having a case where the bigger folks are complaining, saying, hey, I talked to some of my friends that are down the street, and you haven't even talked to them yet, and yet you're been all over me for 3 months, and that's not fair at all. What are you hearing on your side?
I've been hearing this rumored Freddie Mac 5% announcement all week, and here's a note: Freddie announcement to move 5% officially delayed as of this afternoon, confirmed with Freddie. So I've been hearing rumors about 5% all week. And what I've been hearing and telling lenders is that, if you're way over already, they're going to, the implication is probably that they're going to rein you in. And if Freddie Mac also has to make up for the fact that they have lenders who have sold them loans that are way over 5% or 7% already, and they are going to have to scale everybody back in order to make up for some of the millions or billions that have already been sold to them in those two programs. And it's really too bad just in general, because it's easy for an agency to come out with some kind of announcement like, oh, 7%, and oh, we're not the ones putting 7% cap on there. It's we'll blame Treasury over there because they're the ones who wanted 7%. But the devil is really in the details, the implementation of these things, and the confusion that it, the curveball that it throws to lenders helps the borrowers in no way, in no fashion, and it really doesn't help the taxpayer. It doesn't help the agency's risk profile. It doesn't help their reputation. Certainly helps the non-QM investors that are out there licking their chops over these changes and saying, well, don't forget us. We've got these programs and wave it on in, or the investment banks like BAML who are able to securitize some of these things because, as at some rate and some price, an investor will be interested. And if you are able to, at this point, G fee, if you're able to, it's a good thing it could be a good thing for borrowers. So anyway, Rich, are you back now?
Hey, there he is. Yeah, you're right.
Can you guys hear me? I'm having connectivity issues. Can you?
Yeah, you sound like Porky the Pig.
All right, give me one more second. It'll be quick, I promise.
All right. Hey, while Rich fumbles around with his modem or whatever the heck he's using, or rabbit ears, maybe Rich, go to another room besides the basement. I wanted to ask you, there's this old saying about follow the money. And I know that you, it's not necessarily a hedging thing, but I know that you follow kind of, Euro dollars and Bitcoin and so forth. Where do you see the flow of funds these days with investors?
It's funny, the Bitcoin, I wish I had some of that, but no, I don't ever have any of that part. But one thing that a lot of people don't realize, the euro dollar you brought up there, the euro dollar futures market. It sounds like it has to do with euros or something like that, and it doesn't. These are all the bets on the Fed funds rate, of course, as you well know. But for everybody else, the Fed funds rate going out 10 years. And it's an incredibly liquid market. If you take a look at all the euro dollar futures that are there, again, these are all the bets on Fed funds rate. It totals about $15 trillion, not billion, $15 trillion. So it's good to listen to economists. It's good to hear them talk about, well, we think the Fed's going to take off at the end of 2022 or 23 or whatever that is. But if you want to find out what the market really thinks, you should watch those people who have hundreds of billions of dollars bet on that outcome. And one of the things that I think people can see too, when you go back to where the 10-year was and where mortgage rates were at the end of 2018, right? In November, we were writing loans at 5%. And then suddenly there was this big paradigm shift, right? And we went all the way, even before the pandemic hit, the 10-year yield dropped precipitously. That went lockstep with, if you looked out, they're called blues. They're the euro dollar futures about 3 to 4 years out. If you look at the market bets on that, they went from betting that the Fed funds rate was going to be in the, I think it was around the 3.25 type area, all the way down to $1.30, even before the pandemic happened and the Fed took interest rates to zero. So they're very well correlated. And they're actually there. I was going to talk about this earlier this week, and Bloomberg actually put an article out on some big options bets that have been made in that, thinking that Chairman Powell in the Jackson Hole, their usual August meeting out in Jackson Hole, was going to allude to the market about, here's what we think is going to happen with tapering. Here's what the plan's going to be. And then it was going to be a negative surprise. Instead of looking at maybe 5 tightenings, eventually we're going to look at 7 tightenings. I think that they may have got the rug pulled out from under them on the bet on the non-farm payroll print so far this morning. But there's some pretty big bets that have been made out there. And it's a good way to tell really, what does the market really think about the liftoff, which of course we need to have taper first, Chairman Powell said, before we have liftoff. But what do those levels look like? And not to talk about Eurodollar futures levels, but if you look at them, what the market expects is first quarter of 2022, roughly a quarter point. First quarter of 2023, 3/8, so really no liftoff. Again, these are aggregate bets. So some people were betting nothing. Some people were making big bets. This is kind of the aggregation of them all. First quarter 24, 92 basis points on a Fed funds rate. First quarter 2025, $1.50, and really not till the first quarter of 2026 that the market's betting that we're back up to a 2% Fed funds rate. So we'll see. Those things are always changing, right? The nature of markets and expectations is that they're data dependent and they're always fluid. You can take everything you thought in January of 2020 and throw it right in the dumpster and light it on fire about 2.5 months later, right?
It's a good way to put that. Speaking of just market trends and so forth, the non-farm payroll number, caused, it was supposed to be up a million. It was up 200 and whatever. And so the market rallied, rates dropped immediately. 10-year hit 146, 147. And now we're back to where we were before the number even came out. And it's you talk about getting whipsawed and a volatile market. We've sure seen it today. All of the experts earlier this year were calling for higher rates as 2021 moves along. And I understand the expectation that with the stimulus packages and the economy starting to pick up, and I've been out traveling this week especially, and it appears like the economy is going to pick up, and there's a lot of people who want to go spend at travel, entertainment, and so forth. But frankly, it's not being borne out necessarily yet with the numbers. We're not, rates moved up back in February and March, April, maybe a little bit, and have since come back down. I mean, 30-year rates are back in the twos. And so we're back in a situation where rates are great, but there's no inventory, as Rich may attest to if his internet works. And we have a situation though where refis, people have refinanced and they're happy with their 30-year rate in the twos. But it'll be interesting to see as 2021 goes along, because I'm not convinced. I think the MBA is calling for mortgage rates up in the threes by the end of the year. That may happen, but Chris, do you have clients who will say, you know what, Chris, I know the model says we should sell this, but you know what, I think rates are going to head down, and so I want to hold off? And what is your discussion like with folks like that?
We don't see much of that. Generally, all the people we work with are wonderful people. When it comes to this kind of stuff, they like to play things really close to the vest, which I'm glad about. That helps me to sleep better at night too. I think it's one thing if it's part of an organization, especially if you're a depository or you've got a large servicing portfolio, you take a look and say, all right, from an enterprise perspective, it's okay to say, all right, we think this might be the future direction of rates. But take a look at what's, if X happens, what's that happen to my servicing portfolio? If you're a depository, if you're a credit union or a bank, how do changing interest rates affect commercial loans that you have? We see some folks that like to take a look at it from a broader enterprise perspective. Not they're necessarily making a call and saying, I think mortgage rates are going from 3 to 4 or from 3 to 2. But if the market does X in mortgage land, what's that do overall to my business? What's that do to my servicing portfolio, and what does that do to other elements of it? The tough thing that everybody sees is, when interest rates go up, especially if you're a bank who's strong in mortgages or you're an independent mortgage company, it's margins shrink at the same time. It's tough to avoid getting punched in the face as interest rates go up. So there's some people that prefer to be more defensive. I think a lot of it just depends on your overall enterprise risk and what matters to you and what's going to affect, kind of taking a look at things of not just what's my basis points per loan, but what does this do to my GL for the month? What's this do in the overall to my GL for the quarter?
Yeah, exactly. Rich, are you back?
And my connection is wonky.
No worries.
I don't know if a lumber poacher took down my connection pole, but am I still freezing up?
I can hear you.
Yeah, pretty good. You just have to talk without interruption.
So where I'm curious to get your guys' perspective is on inflation. Inflation, a potential killer to mortgage rates, eats away at the return of fixed income assets like mortgage bonds. And, there's obviously been a lot of talk about inflation out there. Federal Reserve, as they have been, does not seem concerned. But when you start to take a look at commodity prices, the way that it is, permeating its way into prices of other things in the marketplace. Curious to get your guys' perspective on inflation, the risk of it, and maybe a little broadened perspective on how it impacts mortgage bonds and mortgage rates.
You want to lead off, Rob?
Yeah, I'll jump in with some tasty tidbits of information, Rich. So I was just writing my introductory paragraph for tomorrow's commentary, and I was talking about the price of chicken wings skyrocketing. Today I wrote about the price of strawberries, going way up.
Mhm.
I know copper is at an all-time high. Lumber, I think lumber trucks are going to start having armed guards on them with the way their prices are going. And so you have bits of inflation that are out there that are certainly being reflected in the housing market. I mean, look at the price of housing. A lot of other things, I just don't see inflation occurring. The price of neckties or dress shoes or sweat socks. But all it takes is a ship getting wedged in the Suez Canal, and all of a sudden, things go to hell in a handbasket. And you've got chip problems that are holding back car manufacturing. I mean, it's very interesting. So a year ago, we were dealing with I think I mentioned it today, like an anti-demand price shock. And now we're dealing with the opposite, that there's this demand for copper wire or lumber or whatever, my chicken wings. And so the prices, I mean, it's like, what these things have become last year's toilet paper. These shortages, whether they're perceived or actual, have driven prices up. And it's almost a self-fulfilling prophecy, it seems like, because you start talking about inflation and you ask the average person on the street, it's like asking them about gluten, define gluten. I stay away from gluten. Well, what is it? I don't know. Why is inflation bad? Oh, inflation's bad. Well, why? Well, I don't know. They're not quite sure. And the Federal Reserve has come out for a long time and said, 2.5%. We want that's a good level of inflation. So everybody will be watching the consumer price index and the producer price index as we move forward. But the fact of the matter is, a little bit of inflation is okay. A lot is not good. And the Federal Reserve obviously cannot control the price of copper wire or the price of lumber. And so I know that the Federal Reserve presidents are all keeping a very close eye on that. And sure, one of the things that inflation does is erodes the return of fixed income investments like mortgage-backed securities.
Mhm.
And so the fear of, if you're earning 2.5 or 3% on your mortgage-backed security portfolio, and suddenly inflation is 4 or 5%, that's a losing proposition. So, I think that fixed income investors are a little bit skittish right now, given some of the flare-ups that we're seeing in the inflation picture in different parts of the economy. So yeah, I mean, that could nudge rates higher as well. Chris, what are your clients and what are you seeing out there?
I also think that I think you've nailed it spot on. I think part of it, I think they'll say think privately or say privately. The Federal Reserve, they're kind of in a place now where inflation's been this I don't know, the boogeyman for 20 years, 25 years. The government keeps spending lots of money. We keep saying, oh, this is going to be terrible. We're going to have inflation. It never shows up. We never get it. And I think the current Federal Reserve now is of the opinion, privately anyway, that they don't care. Well, you know what? Let's see if we get inflation. If we get inflation and it's not transitory, which is the word they like to use, then we'll do something about it. And I think there might be even something that maybe this is kind of stretching a little bit, but because we've always been vigilant on inflation, because obviously during the 1970s and the early 80s, it was destructive, and it left decades of heightened inflation expectations in its wake. Is that if the whole the saying around among economists is always the Fed's job is to take the punch bowl away just when the party's getting started, not when the cops come, but when the party's really getting started. But the problem is when you're doing that is that as the party's raging and finally the people on the lowest end of the economic spectrum are employed and they're doing well, nope, now we have inflation, we're going to take the bowl away. And those folks that were the last ones to get to join the party are the first ones to lose their jobs. And there's something to be said about, we're so worried about inflation, but we've got a dual mandate, and let's place a lot more emphasis on employment and less emphasis on inflation, at least because in the last 2 decades anyway, every time we worried about inflation, it's really never showed up. So let's see what happens. Let's invite inflation over and see if he shows up.
This is the Rundown with Rob and Rich. I'm Rich Swerbinski with the Mortgage Collaborative, joined by Rob Krisman, and a special guest host this week, the founder of Ice Capital Markets, a hedge advisory firm out of Michigan, Chris Bennett. And I mean, for me on the inflation side, I could care less about if the price of a loaf of bread goes up 50 cents. I'm looking at how it could affect the mortgage industry and our members. And it could be, I mean, and I think the way that you portrayed that the Fed perceives inflation, I think is spot on, that they're not really concerned. If it comes, then let's see what happens. Let's focus on employment and stimulus and all these other things. But the impact it could have on the housing market, I mean, let's just think about what would happen to housing and the ripple effect it would have on the economy if 30-year fixed rates were to go, if inflation were to grow at unhealthy levels, 30-year fixed rates were to get into the mid-fours in a quick period of time. It would obviously impact the purchase market, especially with the affordability components related to house prices. I think a lot of us are more optimistic about refi business this year because the cash out refi business that we may see from people that want to improve their own homes, maybe as opposed to buying one. I think it would take away all that cash out refi business. Nobody's going to cash out refi a 3% or a 2.5% 30-year fixed rate in the 4.5%. And the Fed is the one that is buying more bonds than anybody right now. Obviously, they're manually kind of keeping interest rates low. Does the Fed have the firepower to combat inflation-fueled sell-off in the MBS market? And what would be the impact to the economy? Would it be like if they fight inflation over and it shows up? Like, I think just the impact to housing could be really horribly negative for the overall economy, maybe more so than the Fed's even considering.
Well, so Rich, let me, I'm gonna, what is it called? Turnaround is fair play or something. So I'm going to ask you a question here because you just went down that inflation tirade and housing market. What are TMC members doing about the possibility of that? Or what would you recommend that they do, if anything? If they sense that you are right, that this is going to have ramifications. I mean, what as a small to mid-sized lender, even a large lender, what do you suggest they do?
Well, I think that they're maybe not afraid of inflation and all the fear mongering I just laid out there, but they are afraid of more than ever the seasonality and the roller coaster up and down of our business, because they remember winter of 2019. And then they just seen the exact opposite of that last year. We just did a comprehensive survey of 600 key executives from our 228 lender member companies. And the number one issue by far is modernizing their operational infrastructure, insulating themselves against the highs and the lows, having to do what they did last year, go out and just hire, pay, train, bring people on, pay out the nose, retention bonuses. And then now as things are slowing down, they're like, we got to get rid of people. Like that is such an inefficient way to run a business. And it's been our industry, but I think that's where lenders are hyper-focused for good reason. Trying to figure out, through technology and outsourcing and just ways to modernize their operational infrastructure to insulate against that.
Yeah, I think what I'm hearing from small and mid-sized lenders is the trickle down impact to their clients, to their borrowers, and how, Chris, you talked about the employment or unemployment data and so forth, the trickle down for the credit of clients. How is this going to impact credit? I know a couple months ago when we had Tracy from Partners Credit on the show, her focus was, and what she was talking about were the credit profiles of borrowers and how those may change and so forth. And obviously that impacts the bottom line for a lot of lenders because you can't give a loan to somebody necessarily if they're out of a job. To Chris's point about unemployment, and Rich, if they are being negatively impacted because of the inflation picture, and they can't refinance or they don't want to refinance, it has implications for our industry. So yeah, it's a very valid point.
We did have a question come in the Q&A. What are the panelists' thoughts on the true rate of unemployment stat developed by the Ludwig Institute for Economic Prosperity? Should lenders be looking more at this data versus traditional unemployment rate from the Bureau of Labor? That's the one that we all know, in determining the market's overall potential for purchase business. Chris, that one sounds right up your alley.
Well, one thing I guess, and not to do it, I think it's a good parallel on it. Chairman Powell likes to talk about, before we got any rate hikes, when are we going to have tapering? He says we want to see substantial further progress. He said that's not $1 million, $1 million increase, or sorry, $1 million job increase. We need a series of these. But I think they bring up a very good point. What's the unemployment rate that comes out from the BLS? Actually, anybody who wants to go check it out, it's really interesting, bls.gov. You're right, regardless of what party is in power, the party in the White House always says things are great. The party that's not in the White House says things suck. These numbers are all fake. Now, the numbers aren't fake. What they put out there, it's imperfect. They're done from surveys, and they've got seasonal adjustments to them. There's a lot to this methodology, but it's also pretty open book. It's not a black box thing where they say, well, this is the number and we're not going to tell you how we came up with it. Chairman Powell himself likes to he's got kind of an alternative definition for unemployment. The one we're used to seeing that, we thought was going to go from 6% down to 5.8 and it went up to 6.1 today, is known as U3 of the six. The U6 is the underemployment rate people talk about sometimes. The one we're used to seeing is U3. That's the regular unemployment rate. Chairman Powell likes to also add in two things. One is that there's an element, and actually the BLS talks about this, there are misclassified workers now because of the pandemic, where the real unemployment rate, actually if it weren't for this misclassification, is higher than they're publishing. But they're also trying to publish data on here's what we think the misclassification is. So Chairman Powell likes to add that in. He also likes to add in how much the labor force itself, people exiting the labor force, how much that's come down since February, since the start of the pandemic. He says, all right, I'm going to take the unemployment rate, I'm going to add misclassified workers, I'm going to add how much the labor force is been reduced, and that's what I want to see get back down to my 4% rate. It was 10%. He wants to see it go to 4. When you add those back in, our 6.1% of today is really about 9.3. So if you kind of take a look at it as substantial further progress is getting halfway from the 10 to the 7. We've got a long way to go. Again, we're only at 9.3 and it's not getting much better. There's a lot of different reasons for that, I guess, right? Anybody who, it's more than just bars and fast food places can't seem to hire anybody. But there's, this kind of adjusted unemployment rate. I think, I don't know who brought that up in the chat. I apologize. I forgot who you said it was, but it's a really good thing to bring up. It's not just what comes out of the BLS. There's the real number, or maybe the number we should focus on more, is considerably higher than that.
Yeah, I think, Chris, to your point, and people, there's always faults about CPI, PPI, unemployment, weekly jobless claims. Well, what do they include? What do they don't include? But at least they are, to their credit, consistent. If I step out on the porch and it's warmer than it was yesterday, and somebody says, well, that's not the real temperature because your porch is in the shade. Well, still warmer than yesterday. And so I know like everywhere else is going to be warmer in the area. It's a gauge. That's what it is. And to compare them, month after month after month, you see the trends at least. But yeah, there are faults with every piece of data that's out there. So anyway.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined by Rob Krisman and special guest host Chris Bennett of Vice Capital Markets. And I want to get into some Fannie Freddie stuff, a lot of stuff percolating there as it has been for a while now. The Fannie Freddie low income refi program, like 94 caveats, is anybody going to qualify for this thing? We've got I think you guys were talking about it earlier as I was going in and out, what's coming next. We've had a lot of members telling us they're being told 5% from Freddie Mac on the non-owner. What are the next PSPA tentacles that are going to be put out there in the marketplace. Fannie and Freddie, almost $8 billion in net income in the first quarter. I'm a believer like that. And I agree, like they need to be recapitalized. The healthy and normal thing is to recapitalize them and put them on a plan to, be deprivatized. That I think makes sense to everybody. But the capital requirements to which they're being held to and to get to that point, are they unrealistic? It would take another calamity really to the level of the mortgage meltdown of 07, 08. Is that realistically going to happen again? It could, of course, but is that, I would argue they don't have to be that capitalized to be at least deprivatized to some degree. I know there's the Supreme Court case we've talked about for a while. I've been reading some stuff online from people that own either common or preferred shares of Fannie and Freddie stock that are so riled up about this and the way that this case could go. And, most expect it'll go in the government's favor. If it doesn't, there could be some really crazy things that happen with the agencies and the GSEs, but I threw a lot out there on the Fannie Freddie front. Chris, I'll start with you this time. React to those 93 GSE topics I just threw out there.
I wish I knew how the Supreme Court resolution was going to go as well. I think actually Bob Brooksmith did a good job in the recent letter he put out this week of saying, it's a pattern of market disruptions, and really FHFA has gone from they become a disruptive force instead of a source of stability. And I guess when you're in a locked, soundproof room by yourself and you scream and no one hears you, it doesn't matter. But I'm glad we're still screaming about it because it does matter. I want to ask too. I was talking to Victoria DeLuz of Success about this earlier today. Home Ready and Home Possible. Is refi now and refi possible? How are those different from programs that already exist? Is it, I think you talked about, Rich, the new programs coming out. Does anybody actually qualify for them? Did anybody change with that? I don't know.
I know there's somebody put in the chat, there's reduced mortgage insurance on Home Ready and Home Possible, and I guess there's not on the new ones. They waived the adverse market fee on the new one if you're between, I forget, it was like 120 and 300. Why would they not just waive the adverse market fee on all these low-income refis?
Isn't that the case though on the existing programs?
On the Home Ready and Home Possible? I don't think so.
I thought it was. No? Okay.
Is it? Oh, all right. Then it would be maybe, I don't know. All I know is every single lender member I've talked to, they're not even really interested in, they just feel like there's no ultimate audience for the product. That most of the people that I think the government is looking to help with this product are probably on FHA loans. And it would have made more sense to do something through HUD and FHA. So it doesn't seem to make sense to me. But again, I've heard that this was like a Calabria, like single, person.
Trying to get some good press.
I guess. I don't know.
So it flashed up where that Home Ready won't have the refi fee.
Okay, so it doesn't have, so Home Possible and Home Ready don't have the adverse market fee. Okay, so
that's a good thing.
Somebody else put in there, the new programs have a credit for the appraisal fee. That's right. An expanded DTI to 65%. However, with the PSPA high risk factor issue, these would also count against the 2 of 3 rule that was yet to be implemented. So thank you.
And that's 3%, right? 3% is the limit on the 2 out of 3 rule for refinances.
Yep. What about recapitalizing the agencies? To me, it is they're being held to an unrealistic, like to recapitalize them to the levels that Calabria wants to, it'll never happen. I mean, they're making billions of dollars a quarter. They should stop sweeping that in the treasury. They should start retaining some of that capital and working towards some kind of realistic tiered recapitalization goal. Doesn't that make sense? There's something I'm sure I'm missing there, but it seems to make sense.
They are. Rich,
yeah, they are getting to retain it now, but how fast can they? Yeah, you're right. I mean, what they want them to get to, is that going to be 40 years from now? I like your idea, Rich, of talking about a tiered type structure. All right, once you get to X, now we can do this. Once you get to Y, we can do this. Otherwise, where are the goalposts and how often do they get moved?
Right. It's like you know, you have a son or daughter and they're earning $1 a week in allowance, and to buy a car, it's going to cost $5,000. Well, gosh, they're going to save their money for 10 years. And by then the goalposts, you know, things will have changed. So Rich, I'm in total agreement that you know, maybe getting them out of conservatorship isn't necessarily the end all goal, but to continue to bolster their capital and maybe reevaluate at some, you know, date in the future might be the way to go. Because yeah, to come up for each one, even if they're making, you know, $5 billion a quarter, and if they need $250 billion to be recapitalized, that's, you know, we'll all be dead. And so it's like, all right, well, maybe we can figure something else out. But I'll tell you, in the meantime, when I talk to, once again, like the mortgage collaborative clients and so forth, the small and mid-sized companies that are out there, they're like, you know, they're going to do what they're going to do. But in the meantime, I've got to help my clients. You know, we're here, we're trying to scramble to help our borrowers get in under some of these guideline changes, some of these caps, some of these sales caps. I mean, they are scrambling to help people now. You know, every once in a while, whether or not Calabria is even in his job by Labor Day creeps into the conversation, given what the Supreme Court will, I think, be ruling on in early June, which will be interesting to see because, you know, there's the discussion out there that, you know, he's going to resign and the Biden administration will put somebody in new, and that person will recant on all, will change all these guidelines anyway and make them all more borrower friendly. You know, there's that school of thought. So yeah, there's a lot going on out there, frankly, for lenders to kind of keep track of.
It really is.
Swerbinsky for FHFA director.
No, that's the last thing. Trust me. Yeah, no. We've got just a few minutes left here, but do we need Fannie and Freddie? Do we need two GSEs? I would argue there would be boatloads of efficiency in combining the 2 to 1. I understand why a second was created after the fact, but I'm looking at the marketplace right now, and I know there was differences in how their bonds traded. That really doesn't exist anymore from the way I understand it. But to me, that would also make sense to combine the two agencies into one. No, am I crazy there?
I like competition.
Yeah.
Go Michigan or Michigan State. Who are you rooting for there, Chris?
What? Rob, is your camera off?
Where were we? Oh, competition.
Are they really competing against each other right now?
So well, they are a little bit. Fannie Mae's always, you know, always got about 60 or 65% market share. Fannie or Freddie Mac has, you know, 30, 35, 40% market share or whatever. But I will say, Rich, to your point, and not that it impacts everybody on a day-to-day basis, but if you were to design if you know, Rich Swerbinsky were to set up the mortgage operation on Mars or in Antarctica from scratch, it would be highly doubtful whether you would replicate the United States housing finance system if you were starting from scratch. It's a case study in things that have been very beneficial for people and things that have gone awry and terribly awry in other cases. And so, yeah, why don't we have a competitor for FHA? Why don't we have a competitor for VA? Why don't, you know, et cetera, et cetera, et cetera. So yeah, I mean, but given that this is kind of the hand that we're dealt, yeah, I don't know if we need both, but to Chris's point, it's nice keeping both in check. And I'll tell you this, not that and then I'll stop droning on, but it's very hard once you have a regulator in place and a functioning bureaucracy like the FHFA, which oversees Fannie Mae and Freddie Mac. It's hard for the folks at FHFA to get rid of their own jobs. You know, they like overseeing Fannie Mae and Freddie Mac, and they're not going to fire themselves because ending conservatorship would in effect, you know, change the FHFA's role entirely. So my 2 cents.
I say let's go to 4 agencies. Let's have more competition. you know, in the end, you've got to have that. People best X them against themselves every day. So I think I think with Ginnie Mae, it's different because it's government and one rule for everybody.
Do non-QM investors go into one of those agencies?
I like that. I think one of the great benefits of going to UMBS, and it hasn't happened yet, but one of the great benefits is it makes it easier for others to securitize and have a common structure to help form those UMBS securities. It hasn't happened yet, but I'm hopeful that it will. I think more competition is better, and the structure has been put in place. It's taken a long time, but I'd love to see more into the space.
Great point. All right, we are out of time for this week. Flies by as usual, especially if you missed the first 12 minutes with your internet connection freezing up. It went by especially quick this week. I apologize about that. But as always, Rob, great seeing you. Good to see you caught the great Willie Mays birthday, even though you were a day late.
Yeah.
You're native San Franciscan, right?
Yeah, and like I said in my commentary today, we met him at Halloween. All the kids were lined up outside his house south of San Francisco there, and he was giving out. Actually, that year he was giving out programs from games from the 1960s. So anyway,
Wow.
So we had a program.
Yep. And Chris, as always, good to see you. Thank you so much for joining us these last couple episodes and espousing your capital markets wisdom on our audience. Really, really enjoyed it. And for our members, if you're looking for a hedge advisory firm or are unhappy with yours, Vice Capital, I am a former client for many years, living proof that they just do a great job of many happy members that are Vice clients, and happy to connect you with any of them if you want to learn a little bit more about what Chris and his team up in the great state of Michigan do.
Did your mouth burn when you said that? Thank you, Rich. Really appreciate it, Rich and Rob. Thanks guys so much for having me, letting me join you the last 2 times.
You bet. Good times.
And as always, to our audience, thanks for joining us every other Friday, 3 p.m. Eastern. There's been some drum banging to bring this program to weekly. We're assessing that possibility as we get into the year. And as always, we load these videos to our YouTube channel, release it as a podcast as well. I know a lot of you listen there as well. So until 2 weeks from this Friday at 3 p.m. Eastern, we'll see you then, and have a great weekend, everyone. Take care.